Ladies and gentlemen, Asian guy here. I need you to stop what you're doing right now. Put down your phone, turn off CNBC. Because what I'm about to show you changes everything we thought we knew about Warren Buffett. At 95 years old, the Oracle of Omaha just made the most shocking financial move of his entire career. And it has nothing to do with stocks. This isn't about Apple. This isn't about Coca-Cola. This is about something so fundamental, so dangerous to the existing order, that the financial media is completely silent about it. They don't want you to connect the dots. They don't want you to understand what Buffett sees coming. For 70 years, Warren Buffett has been the ultimate buy and hold investor. The man who told us to bet on American business. The man who said derivatives are weapons of mass destruction. The man who preached patience, value, and the power of compound interest. But in the last 6 months, that same man has been quietly, systematically, doing something that goes against everything he's ever publicly stood for. He's been converting his empire into physical assets. Not stocks, not bonds, not even cash. Physical, hard, tangible assets. The numbers don't lie. In the third quarter alone, Berkshire Hathaway sold $36.1 billion worth of stock positions. That's not portfolio rebalancing, that's liquidation. But here's what the headlines missed. Here's what they don't want you to see. Buffett didn't put that money into treasury bills like they reported. He converted it into something far more interesting, something that suggests he knows exactly what's coming next. We have confirmation from multiple sources inside Berkshire that the company has been quietly acquiring industrial real estate, not office buildings, not retail centers, industrial facilities, warehouses, distribution centers, energy infrastructure, the backbone of the physical economy, properties that produce actual goods, move actual commodities, store actual inventory, real assets that function regardless of what happens to paper markets. This is where the story gets strange. Warren Buffett, the man who famously said he doesn't invest in what he doesn't understand, has been buying assets in sectors he's spent decades avoiding. Mining operations, agricultural land, water rights, energy storage facilities. These aren't traditional Berkshire plays. These are survival plays. Think about it. At 95, why would the world's greatest investor suddenly pivot away from financial assets and into physical ones? What does he see that we don't? What information does he have access to that the rest of us are missing? The answer lies in something that happened 3 weeks ago, something that barely made the financial news, something that most analysts dismissed as routine corporate housekeeping. Berkshire Hathaway established a new subsidiary, a quiet little company called Omaha Physical Holdings. The filing was buried in SEC documents, no press release, no investor call, just a simple corporate structure change that gives Berkshire direct ownership of physical commodities. Now, you have to understand how unusual this is. For 7 decades, Buffett has avoided commodities like the plague. He's called them unproductive assets, dead money. But suddenly, at 95, he's creating infrastructure to hold them directly, not through ETFs, not through futures contracts, physical possession. We've been tracking the movements. In the last 90 days, planes registered to Berkshire subsidiaries have been making regular trips to precious metals, depositories in London, Switzerland, and Singapore. These aren't tourist flights. These are cargo runs, heavy cargo runs. The pattern becomes even more suspicious when you look at Buffett's recent public statements. 3 months ago, at the annual shareholders meeting, he said something that sent chills down my spine. He said, and I quote, "The game is changing. The rules we've played by for 50 years are not going to work for the next 50 years. When Warren Buffett talks about rule changes, he's not talking about SEC regulations. He's talking about the fundamental structure of the monetary system itself. This brings us to the phone call that changed everything. According to sources close to the Berkshire board, Buffett received a briefing in late September. A briefing from people who don't usually brief private investors. People from agencies that operate in the shadows. People who understand the difference between public information and actionable intelligence. What was in that briefing? We can only speculate, but we can look at what happened next. Within 48 hours of that meeting, Berkshire accelerated its stock liquidation program. They canceled 3 planned acquisitions. And they began what can only be described as a systematic conversion of paper wealth into physical wealth. The timing is everything. This conversion began exactly 2 weeks before the Federal Reserve's emergency liquidity operations spiked to unprecedented levels. 2 weeks before the repo market showed signs of stress. 2 weeks before foreign central banks began dumping U.S. treasuries at an accelerated pace. Warren Buffett didn't just see this coming, he positioned for it. But the most telling move isn't what Berkshire bought, it's what they stopped buying. For the first time in his career, Buffett has ceased purchasing bank stocks. 0 new positions in JP Morgan. 0 new positions in Bank of America. This is the man who once said banking is the best business in America. Now he won't touch it. Why? Because banks are fundamentally paper institutions. They create credit, manage deposits, and facilitate transactions. But in a world where paper loses value, where digital systems fail, where trust in institutions evaporates, banks become liabilities, not assets. Physical assets, on the other hand, remain valuable, regardless of what happens to the currency that prices them. A warehouse full of grain doesn't care if the dollar collapses. A water treatment facility doesn't lose function if the stock market crashes. Energy infrastructure continues to generate value even if the financial system seizes up. This is what Buffett understands that most investors don't. We're not just facing a market correction or a recession. We're facing a systemic reset, a fundamental shift in how value is stored and transferred. And in that environment, the winners won't be the ones holding the most paper. They'll be the ones controlling the most physical reality. The clues have been hiding in plain sight. 3 years ago, Buffett began stockpiling cash, not investing it, stockpiling it. Berkshire's cash position grew to over $150 billion. The financial media called it dead money. They said Buffett had lost his touch. They said he couldn't find attractive investments. They were wrong. He wasn't accumulating cash because he couldn't find investments. He was accumulating cash because he was waiting for the right moment to exit the financial system entirely. That moment appears to have arrived. We're seeing similar patterns across other institutional players, the sovereign wealth funds, the family offices, the ultra-high net worth individuals who have access to information that retail investors never see. They're all moving in the same direction, away from financial assets and toward physical ones. The Norwegian government pension fund has been quietly divesting from financial stocks and increasing its allocation to real estate and infrastructure. The Saudi Public Investment Fund has been purchasing agricultural land across 3 continents. Even the Vatican's investment arm has been shifting away from bonds and into physical assets. This isn't coincidence, this is coordination. These institutions don't move independently. They move based on intelligence. Intelligence that suggests the current system has a shelf life. But here's what makes Buffett's move different. Here's what makes it so dangerous to the establishment. Unlike the sovereign funds and the family offices, Berkshire Hathaway is a public company. Its moves are visible. Its strategy can be analyzed and copied. When Buffett shifts toward physical assets, he's essentially telling 500,000 retail shareholders to do the same. The establishment cannot allow this message to spread. They cannot allow the Oracle of Omaha to legitimize a flight from financial assets. Because if retail investors begin converting their 401ks, their IRAs, their savings accounts into physical assets, the entire debt-based monetary system collapses overnight. This is why the financial media is silent. This is why the story isn't on the front page of every business publication. This isn't oversight. This is suppression. Think about the implications. If Warren Buffett, the most successful investor in history, is converting paper wealth to physical wealth, what does that tell you about the future of paper wealth? If the man who built his fortune betting on American financial institutions is now betting against them, what does that tell you about those institutions? The answer is simple and terrifying. The system is ending, not tomorrow, not next week. But the process has begun. The smart money sees it, the connected money is positioning for it. And Warren Buffett, at 95, is making sure Berkshire survives it. But survival isn't just about having the right assets. It's about having the right assets before everyone else realizes they need them. It's about moving early, quietly, and decisively. The window is closing. Every day that passes, more institutional money moves toward physical assets. Every day that passes, those assets become more expensive and harder to acquire. Every day that passes, the gap between what the financial markets say things are worth and what they're actually worth widens. Warren Buffett built his reputation on being early, on seeing value before the market recognized it, on positioning for trends before they became obvious. At 95, he's making his final bet, his biggest bet. Not on a company or a sector or even a country. He's betting on physical reality in a world that is about to remember the difference between real and fake. The question isn't whether this trend will continue. The trend is already unstoppable. The question is whether you'll recognize it before it's too late. Warren Buffett has spent 70 years studying markets, studying cycles, studying the patterns that determine where wealth flows and why. His conclusion, expressed through action rather than words, is clear. The age of financial assets is ending. The age of physical assets is beginning, and the transition won't be gentle. By the time the financial media admits what's happening, the best opportunities will be gone. By the time the average investor understands the shift, the prices will have already adjusted. By the time the government responds, the new reality will already be locked in place. This is how systemic changes happen. Not with announcements or warnings, with quiet movements by people who understand the game better than anyone else. Warren Buffett is 95 years old. This is likely his last major investment thesis, his final message to the world. Buffett is not just protecting Berkshire from market fluctuations. He is positioning it to profit directly from the coming chaos. He is calculating for a scenario where confidence in financial markets collapses, digital wealth vanishes with a keystroke, and paper promises become worthless overnight. When people panic and rush toward tangible, touchable, and storable real assets, Warren Buffett will be the one who owns the necessary warehouses, distribution networks, and processing facilities. Every dollar fleeing the stock market or failing pension funds needs a safe harbor, and Buffett is making Berkshire the ultimate destination for this flood of capital. While others trade in financial fantasies, he is cornering the market on physical assets, effectively creating a monopoly on reality. The brilliance of this strategy lies in the fact that, unlike Tesla stock fluctuating with tweets or crypto crashing, due to regulations, Buffett's assets continue to produce value under any condition. A grain silo does not care about Federal Reserve policy, and a water treatment plant does not respond to inflation data. They generate returns regardless of the crisis. However, the most terrifying aspect is what Buffett is not buying. For the first time in decades, he has completely stopped purchasing insurance company stocks, his historic area of expertise. He realizes that insurance companies are betting pools backed by financial markets, and if those markets collapse, these companies will become instantly insolvent. Knowing that traditional insurance models won't survive the Great Reset, he is pivoting entirely toward real assets. Driven by this foresight, Buffett quietly purchased controlling stakes in precious metal storage companies, choosing storage facilities rather than mining companies. He knows that when financial assets collapse, precious metals become the only trusted store of value, and those who control the storage of those metals control access to wealth itself. This strategy extends beyond metals to critical supply chain bottlenecks such as port facilities, transportation hubs, and communication infrastructure. By acquiring infrastructure that everyone will need but few will own, he ensures that when the panic begins, institutions will be forced to accept his prices and terms. This is the construction of fortress economics, a structure built to withstand any storm, collapse, or economic reset. Buffett is betting on the fact that no matter what happens to currencies or governments, people will always need food, water, and energy. He views the unprecedented money printing by central banks and unsustainable government debt as proof that the system has reached its limits and cannot continue in its current form. When he tells his board they are investing for the next century, he is not talking about normal market cycles, but about a civilizational shift. His new initiatives, such as essential services holdings, focus not on growth or innovation, but on necessity, water purification, waste management, and energy, the unglamorous backbone that keeps civilization running. Buffett is investing not just for a collapse, but for the foundation of the new economy that will emerge after the collapse. Although these preparations are made in plain sight through public filings, the media and governments ignore this reality to maintain faith in the current system. However, at 95, Buffett is beyond their influence and pressure, making him the most dangerous man in American finance. His abandonment of a 70-year investment philosophy is an undeniable signal that the old game is ending, and a new game with different rules is beginning. Buffett is positioning himself to control the world that emerges when the current system buckles under its own weight, and those who understand this transition will be the winners of the future. A next step for you. Would you like me to break down the specific essential services, or sectors mentioned in the text, and provide a list of real-world examples or ETFs that align with this defensive investment strategy?